Hi everyone. Thanks for taking your time out to join us from your busy schedule at AIF and PMS Experts India. We are thrilled to introduce our brand new show, Ask the Expert Show. Through webinars, we aim to share insights into diverse asset classes, forecasting knowledge exchange amongst our investor community. So, my name is Devanshu Bindlish, and I'm the Vice President for AIF PMS Experts India. With me, I have a speaker, Mr. Jigar Mistry, co-founder of Buoyant Capital. Let me take a moment to introduce Mr. Jigar Mistry. So, Jigar has 21 years of equity research and investing experience covering sectors like banking, financials, global metals, and mining, utilities, and India strategy. Jigar has previously worked with institutions such as HSBC Capital Markets and Kotak Institutional Equities. Prior to founding Buoyant Capital, Jigar was the director of research at HSBC, advising top global funds on investing in India. Jigar is an associate member of Institute of Chartered Accountant of India and CFA chartered holder from AIMR US. Welcome Jigar ji. How hope you are doing well.
Yes, Devanshu, thank you for inviting me to your show.
Yeah. Jigar ji, today we have an agenda of running your buoyant opportunity strategies. That how do you work first, and then we will come back to the next question after your understanding about your strategy. I am giving you, allowing you to share the screen. You can share the screen if you want and present it.
Perfect, Devanshu. Good afternoon, everybody. Thank you for joining this, and thank you to AIF and PMS Experts for hosting this. I'll briefly run you through sort of who we are, what we have done over the course of the past 8 years that we have been in existence, a brief run through of the philosophy, and maybe 10 odd minutes on where we see the markets going forward. Right. So we started Buoyant in June 2016. So exactly sort of 8 years ago. It was started by three of us, Sachin, Viral, and myself, all chartered accountants with 20 plus years in the equity markets. As Devanshu mentioned, before starting Buoyant, I was the director of research at HSBC Bank. My job was to advise all the foreign institutional investors, largely sovereigns, on how and where to invest in India. Before that, I was part of Kotak, then the JV with Goldman Sachs. Viral is also a CA, I am Ahmedabad alumnus, last the chief investment officer of Nippon Life Insurance, where he was managing around $3.5 billion in equity and debt. And Sachin is also a CA, CWA, last with Nippon Asset Management. Today, we are almost a 53-member team. 13 of us are in research. We are currently managing assets of 4,500 crores in a single equity strategy. Now, that's very important to us as to why just one, but I'll come to it towards the end of the presentation. The vehicles are two. One is a PMS and the second is a CAC3 open-ended AIF. Similar strategies, just two vehicles to access the same. If I break down the rest of the performance in two parts, I'll say at the output stage, we have generated close to 23% CAGR post fees and expenses, which over the longer term places us at the top quartile, 3, 5, 7 years. But frankly, generating the highest possible return is not how we run this fund, right? We want to generate a superior returns, no doubt, but that has to come adjusted for risk and across different market cycles. Now, market cycles I'll come to in a minute, but risk is something that can be measured, quantified, and compared. CRISIL does a fairly decent job of doing it across 130 odd PMSs, and we are very happy to state that we've always managed to get the best in class rating, which is a 5-star rating. If I come to sort of the inputs, fundamentally, we are different from other asset managers on three broad accounts. First is the portfolio framework itself. The second is the team structure, and the third is the actual execution of the fund. Now, in terms of portfolio framework, if I have to define ourselves in one line, I'll say we are diametrically opposed to this idea of buy and hold as it is practiced in India. The businesses we may have held for all 8 years of our existence, but we think Indian managers take it to an extreme when they think their job is just to identify a great company, and having identified that, they keep investing in it across time frames, across price points, essentially implying that a good company is always equivalent to a great investment. We don't agree with that line of thought. We believe there was a time when this worked beautifully well. That time was presented with externalities which are very different from the current time. and therefore things have changed. So if we start, let me take you sort of back to the year 2000. What we see externally speaking, we see an economy which has just been liberalized about 8 years ago or so. We see companies which are small and rather circumspect of their future. And at $10 billion of foreign institutional ownership, that was hardly anything. From that juncture, you fast forward 20 years, you see that your economy has grown, but companies have grown at an unprecedented scale, right? So the largest zinc miner in India in the world is from India now, excuse me. They have very large cement, Alcobev, tire, consumption businesses. So on one hand, the earnings of these companies were growing at an unprecedented pace. On the another, foreign capital was chasing it like there was no tomorrow. What was $10 billion grew to upwards of $600 billion by 2020. They ended up owning 44% of the free float market cap in India. They were 2.5 times the size of mutual funds. Right? So if you quantify it in the form of an equation, you'll find that not only the earnings of the companies were growing, so E was growing, the PE was continually expanding as well because there was a lot of money chasing limited good quality assets. And therefore, when E goes up and PE expands, essentially prices do go up. And therefore, for a very long period of time in India, it looked like a good company is always a great investment. However, when you compare over the past 5 years or so, all the ingredients that led to buy and hold working so well have actually inverted. Let's look at the companies. The older economy in India is now saturating. They've grown phenomenally well over the past 2 decades, but the same rate of growth cannot really be maintained going forward. Secondly, look at the newer age economy businesses. Now, those are growing fairly fast, but unlike the old economy businesses, the public market investors are not really the first port of call, right? So, say when Bajaj Finance, which is the largest compounder in the past 2 decades, grew from say 300 crore in market cap to 3 lakh crore in market cap, all the non-promoter gains accrued to us as a cohort of public market investors. Today, by the time a Nykaa, Paytm, PB, Zomato delivery comes up for listing, PEVCs have already extracted a large part of those value, and those businesses are offered to us at a valuation which, at least to us, does not make a lot of sense. And lastly, foreign institutional ownership is no longer the singular driving force of Indian equities, right? If anything, the relative ownership has fallen from 44% of free float to 32% of free float. Domestics have come in their space and to occupy that vacuum created. But we are a very different breed of investors, right? We are here, we are grounded, we are a lot more value conscious. So if I have to sort of distill that differentiation in one point, I'll say most of our contemporaries would view the 23 years in India in one continuum as if nothing has changed. We see them as two distinct eras, right? First 2 decades when buy and hold worked beautifully well, past 3-4 years when it's not working, and given the scheme of things, unlikely to work in the future either. Now, with that backdrop, what's really happening is that the fundamental economic cycles are now taking over and they are in full show. So these cycles manifest in several formats, and I'll bring up my slide deck now and run you through how these cycles manifest and the way we see them. Right. So I'm hopeful my screen, right? So these cycles essentially manifest in several ways at the stock sector market cap levels. Let's start with the cycles at the stock level. I'm zooming out knowingly a little bit to lay a theoretical construct on why these cycles exist in the first place. And then we will come down to the actual examples of these cycles in full force. Right. So let's say if we take time on x-axis and value on y-axis, and say we come across a company that will likely grow earnings at a fairly decent clip for a long period of time. Now, it's not my case that this is not a holy grail and we aren't interested here. But where the disconnect arises with us is that when the market starts believing that because earnings here will continuously compound, share prices also will continuously compound. And in our experience, that rarely, if at all, happens. What typically happens instead is that having found and come across such a beautiful business, the markets initially gets very excited, and therefore share prices start moving up way ahead of fundamental earnings growth. And if you were to watch it from a vantage point of, say, time t0, your previous X year's earnings would have grown at, say, 20% CAGR or thereabouts, but the share price would already go up 4 to 5x, creating the first leg of this cycle where earnings growth is much slower than the growth in share prices. At a certain juncture, nevertheless, the market realizes that you're paying too much to buy a business like this, at which point, the sort of the growth in the share price slows down, something else looks shinier, sort of this keeps going down. And maybe say over 30 years, it all adds up because long term, your EPS and share price growth is more or less similar. But in between, there is this time, the distance between T0 and T1, where the earnings keeps rising and the share prices does not move at all. And it may surprise a few people that this distance can very easily be 10 years. It can equally easily be 20 years as well. So for 2 decades, a company can be a great company, but a very bad investment at the same time. Now imagine identifying this business at time T0. We'll be right in our assessment that the earnings will compound at 20% CAGR, but the share price compounding will be rather sort of muted, relatively speaking. So this is a theoretical construct on why cycles exist in the first place. I'm bringing in 4 examples here. The top two are international companies, bottom two are Indian companies, but I have a long list if somebody else is interested. Let's look at, say, Coca-Cola. Among the best brands, among the best investors, say Warren Buffett buys this in 88. For the next decade, it's a great company and a great investment, up 10x in 10 years. But then for the next 19 years, essentially, while the earnings double, stock returns are essentially zero, right? IBM, 12 years, earnings triple, stock returns zero. In India, Colgate, 15 years, EPS quadruple. So 10% CAGR for 15 years is a long amount of time for you to not make money on the stock. But if you started the cycle by paying a huge valuation, you ended up generating little or no return for an extended period of time. So what you pay to buy a business matters immensely. Now, cycles are not just limited to stock levels. We see those across sectors as well. So what you're seeing here is the Sensex line. We have flatlined it for highs and lows, and you're looking at the best and the worst performing sectors across a few market cycles. Now, I zoom into this period between 14 and 19. Initially, the broader markets fell. Consumption was the best performing sector. Then the markets rose, consumption was again the best performing sector. So for 5 years, market could go up or down. Consumption kept on doing well, which created the narrative that these businesses are so strong that nothing bad could really ever happen to them. Crude could inflate, commodity prices could go up, but it's okay to pay 40, 50, 100p to these businesses because the moat is so wide, and therefore, it's all fair game. In fact, 40,000 crores of alternative assets were raised by funds who are experts at doing it. They kept on investing at all junctures until the cycle peaked. And for the last 4 years or so, most of this money is sadly underperforming quite royally. But for us, this is not the first time it was transpiring, right? Between 2000 and 2008, we saw a similar thing play out with capital goods. And even here, once the market cycle peaked, the capital goods index levels that we saw in 2008 were similar to what they were in 2021. So 13 years of little or no returns, but then true to its cyclical nature, today it's again the best performing sector. So cycles at stock, sector, even market cap level, right? So if you look at the 20-year time frame, your Sensex in small cap has given very similar returns. So one way to think about it is that it doesn't matter where you invest. Eventually, you're going to make the same amount of money. Why bother? But if you had that belief, say in December 17, you were in for a rather rude surprise over the next 2 odd years because the large cap index fell only 12% and the small cap index fell 50%. Now, the narrative at that juncture was that, these companies in India, there are only 20 of these companies which are worth investing. FIs will only invest here, domestics, no FIs will only invest here. So this is the be all and end all of investing. But then the cycle turned around. The entire underperformance of small cap was taken out. Today, we are in fact in the second best performing small cap rally ever, but most opinions are that this rally continues and it never reverses. Right? But if we are viewing this in market cap, sector, and sort of stock terms in a cyclical nature, the way we approach investing is also through cycles. On paper, it's a fairly simplistic sounding framework. We approach the market in one of these two stances. We're either aggressive or defensive. When aggressive, we want to generate a superior return. When satellite part of the portfolio is much bigger than core. Now, what's core and satellite? Core businesses are businesses with very predictable cash flows, industry leadership positions, a well-defined capital allocation structure. So think of businesses like Unilever, Nestle, HDFC Bank, and the likes. A lot of investors invest here, but they invest here exclusively to the exclusion of everything else. Whereas we argue that cyclicals, turnaround stories, value migration themes are all important, and we classify all of them as satellites. So when aggressive, we want to generate a superior return when satellite is a much larger part of the portfolio than core. But then having generated superior returns, we want to protect the capital. That's when we turn defensive. Satellite then becomes a smaller part of the portfolio, core becomes a larger part. So on paper, it's a fairly simplistically sounding framework, but the proof of the pudding is in the execution. And let me then run you through a couple of slides on performance. Right, so two ways to look at it. One is sort of the one broken by time slice. So we started the fund in June 2016. We ran it in an aggressive fashion till September. We generated a significant multiple of the market benchmark at that point in time. But then in September 2017, we turned defensive. The long-term capital gains budget came somewhere around Jan-Feb 2018. Then there was a mutual fund realignment. And in 2018, in the run-up to 2019, the markets completely collapsed in the small and mid-cap space. Our idea was to protect the capital, which we did. We then became aggressive again, generated 72% returns, became defensive in September 21. And since then, we are outperforming. But the idea is to keep this number positive. Now, how does this transpire into annual and average numbers? So the best way to look at it is through the rolling return framework. Over 1 year, there are some 2,558 observations of 1 year rolling returns. And in there, we are sort of generating a 9 percentage point alpha. But you will realize that we are outperforming on only 60% of the observations, right? And this is, I'm sure AIF and PMS experts have a wider gamut of all the funds, but my understanding is this is at the higher end of the spectrum. But what happens when you run up to, say, 3-year rolling return, right? 1,828 observations. But now we start outperforming on 75% of the occasions. We are maintaining a 5 percentage point alpha sort of lead over this. What happens when you reach, say, 5-year rolling return? There are in excess of 1,000 observations here. But now here the strategy starts sort of coming to life. We maintain a 5 percentage points plus alpha. But now the average returns for Buoyant are similar to the highest returns of the index. The worst performance of Buoyant is very similar to the worst performance of index. And we outperform on 94% of the occasions. What happens when you reach 7 years, basically? 367 observations. We are maintaining a wide 7 to 8 percentage points alpha here. The worst performance of Buoyant is now higher than the worst performance of index. The best performance of index compared to the average performance of Buoyant is much lower. And now we start outperforming on 100% of the occasion. So the longer the investors have stayed with Buoyant, whereas the outperformance continues to stay similar, but the probability of generating a positive outperformance goes up quite dramatically. Now, doing what we do, two things are important. One is sort of communication, which involves us being transparent, to which end we don't charge entry load, exit load, setup fees. It's your money. You're free to walk away whenever you want. But where we go above and beyond is communicating what we're trying to do with the fund. To that end, every week, I write an article. It's carried in the Economic Times. I have written 130 articles so far. And here we put out very nuanced views on important topics. Like, say, in 2021, we wrote why the new age sort of companies are not even worth half their valuations. Right? 3 months back, we wrote why credit cards could become a defunct business in a decade once the India stack is fully implemented. So we've written on IT, SaaS, pharma, FMCG, retailing, credit card, banks, utilities, electric vehicles. A lot of our views other than the market are carried every week. Our views on the market are carried every month via fact sheet. Every quarter, we do a detailed webinar with all our investors. And all our media interactions, I think we have given more than 350 interviews across CNBC now. All of this information is put up in the public domain on our website for everybody to see. And this gives you a third-party timestamp on what we were saying at different points in time. The last point I'll mention, and maybe I'll summarize with that, is that if you look at just the output, we are reasonably up there in the alternative food chain. But the beauty of the strategy comes alive once you layer it with risk and consistency. More importantly, we run a strategy which is entirely different vis-a-vis most of our peer set, and we execute it in a non-model portfolio way, which is to say that when aggressive, we have deployed money fairly quickly. When defensive, we have taken a lot of time to deploy, and therefore the question of when is the right time to invest is not really something that's structural with Buoyant firms. And not just when, even where is not a question with us, because we essentially run only one strategy, which is a truly market cap and sector agnostic strategy. So there are times when we are 70% small cap focused. There are times when we are 70% large cap focused, finance, pharma, FMCG, whatever makes sense. This is the only fund that we run, but we back it up all the way to the extent that we have a one fee structure, which is variable only. Here, we don't even charge a fixed fee until we cross a certain positive return threshold. And there is obviously a fixed fee structure too, but there is one structure which is fully variable. And lastly, so much do we believe that this is the best way to run money, that all our listed equity exposure, sort of the founders and their spouses, exclusively invest only through Buoyant funds, right? So we have zero listed equity exposure outside of Buoyant Capital. And by ensuring a high skin in the game, we're truly eating what we serve. We seek to align investors' interest and ourselves, and historically, that's resulted in a fairly long-term relationship with most of our investors. So I think this is the initial sort of, Devanshu, the product presentation that I wanted to offer. How should we take this forward?
Yeah. So thanks, Jigaji, for explaining your product in very, very detailed manner. And I think this is a very well flexi cap fund, which is I think available right now in the market for my investor community. So my investors and everyone would have a common question, as today the markets are trading at all-time high. So what are your views on what are your market outlook views on the markets? If you can throw some lights on that.
Sure, Devanshu. So I'll pull up another slide deck. I'll run you through sort of how we see the markets going forward.
Sure.
Right. So sort of let's quickly run you through this. So basically, I have covered what Buoyant strategy is, but let me quickly run through, the three or four key debates. Right. Until October 2023, the markets appeared like it's fairly in conjunction with the fundamentals. But after October 23, I think two events happened which completely reshaped the Indian markets. First was that the Fed appeared to pivot sooner than expected, and everybody started assuming that the markets will turn around from that standpoint. And the BJP won those three state elections, and everybody assumed that the probability of BJP win has gone up to 100%, which was earlier 0% in their opinion, and that has completely reshaped the Indian markets. Now, what's happened with the US race is very interesting. So, if you look at the implied rate structure through the option implied spreads, you will find that whereas so midpoint today is 5.375. In the month of November, the consensus was believing that the rates fall to 4.44. But after the pivot statement by Jerome Powell, over the next 2 months, the rate cut expectations went to 3.76. So everybody assumed that there will be 7 rate cuts. But since the data has been coming through, the rates have now moved back to levels which are higher than what they were in the month of November. So clearly, the Fed sort of rate cut estimates have not played out. I think they're now expecting just one rate cut instead of what the consensus built the 7 rate cuts to be. Secondly, and from that India standpoint, that's important because if I look at the repo, which is the policy rate for India versus the Fed fund target rate, the differential today is only 100 basis points, which has been the lowest in the last 23 years. So it's unlikely that unless US cuts, India will be in the position to cut. Now, the second point with regards to the Indian exposure is what does 362 get you that 293 doesn't? 293 is a simple majority. 362, which the sort of street was hoping was that they'll get us sort of two-third majority, and that would have none of these actually require a change in constitution, but a very strong majority would have given them the ability to push through a lot of reforms which are political in nature, like let's say UCC or One Nation, One Elections. But a large part of ongoing reforms in the DBT, FTA, debt markets, all those could likely continue. And in our estimates, we will likely see a reasonably strong government. because even without Telugu Desam and Janata Dal United, they are only seven short. And there are, besides these 20, which could be friendlier parties, there are other 10 letters of commendation I think they've already secured. So essentially, at Lok Sabha, they will be fairly okay. In Rajya Sabha, they will be at 49% vote share, seat share rather. So things should be fairly decent. Now, in the process, what has transpired is that if you look at the Indian markets, sort of what has in the way in which the markets have behaved, it's important to know that whereas your promoter community, and this is all listed market cap in India, which is roughly $4.7 trillion. Promoters own 52%, mutual funds own close to 10, FIs own close to 18, and retail owns close to 12.5%. But that ownership between FIs and retail have not been synchronous. So whereas FII's largest ownership are in the large cap space, retail's largest ownership is in the micro cap space. Now, since the past 12 months or so, there are close to 650 companies, 625 plus, that have more than doubled, and 80% of them are in the small cap space. Right now, most of this is transpiring because retail has had a phenomenal run through. So if you look at this table, you will find that retail sort of wealth generation since COVID has increased by almost 52 trillion, 52 lakh crores. And large part of this is coming from gains in the micro cap space. Phenomenal wealth when you compare this to an household saving rate of about only 14 lakh crore. Total mutual fund inflow last year were only close to 2 lakh crore. Compared to that, the kind of wealth that has been generated is truly phenomenal. Now, because of this, what's happening is that a lot of money is getting invested back into the smaller and mid cap spaces and mid cap sort of mutual funds as well. So if you look at the number of folios in the small cap space has more than sort of quadrupled in under 3 years, and the small cap folios are now higher than the large cap and mid cap space as well. So would this be backed by earnings per se? Difficult to say, because if I look at the earnings yield over large cap, the mid, small, and micro cap businesses are now trading. So every time you get into a negative number, you're now trading at a valuation multiple which is higher than large cap. Just because they enter a negative trajectory doesn't mean sort of the market completely collapses immediately. But clearly, sort of they are now getting into a space where they are no longer sort of cheap by any stretch of imagination. And historically, what has happened is that every time you see a 3-year rolling return multiple, which is approaching the 35 to 50% range, the next 2-year returns have always been negative. The right time to buy small and mid caps is around COVID, Fragile 5, global financial crisis, when the number is negative. And that's when sort of you get into a positive trajectory 2 years down the line. So to answer your question, I think the markets are reasonably well poised over the longer to medium term, Devanshu, but over the shorter term, we are seeing this sense that because of a large amount of wealth creation, a large number of money is being routed back either via small caps or in the small cap funds. And many of those spaces are seeing valuation multiples which are far higher than what we would consider normal. And therefore, there is the time to get a little more cautious. At Buoyant Capital, we are now evenly placed. Last year, we were almost 65% into small and mid caps. This time around, we have reduced that exposure to under 50%. And if the rally continues, then that's where we'd like to bring the exposure further down.
Thank you, Jigarji, for explaining about market outlook. So I think as of now, my investor community does not have any other questions. So thanks for giving your valuable time to us and joining over this webinar. We would be hosting more and more webinars with you. Thank you all the investors who have joined us on this webinar to hear us what Buoyant Capital do contact us at www.aifpms.com, and you can reach us at 8368586435. Thanks everyone. Have a lovely day ahead. Take care. Bye.